Every year, Americans pay hundreds of billions of dollars for something most of them don't fully understand. What if the policy you bought to protect your family is actually the wrong one for your situation? Stay with me, because in the next 9 minutes, you are going to learn what insurance agents don't typically explain. Let's start at the foundation. Life insurance is not a savings account or an investment. At its core, life insurance is a contract. You pay premiums, and in exchange, when you die, your insurance company pays a sum of money, called the death benefit, to whoever you've named as your beneficiary. That sounds simple enough, but here's where it gets interesting. The entire business model of life insurance is built on one fundamental principle: the law of large numbers. Insurance companies collect premiums from thousands, even millions of policyholders, and they invest that money. They know, with mathematical precision, how many of those policyholders will die in any given year. And they price their premiums so that the money coming in always exceeds the money going out, plus a healthy profit margin. Think of it this way. When you buy life insurance, you're entering a financial contract where the company has done detailed actuarial calculations about your life expectancy. They've studied mortality tables, enormous databases of death records, to calculate exactly how much they need to charge you so they come out ahead. This is not cynical, it's simply how the math works. And understanding this math is your first step toward making smarter decisions. Because when you know how the business model works, you can use it to your advantage. You can time your purchase for when you're young and healthy. You can choose the right type of coverage. And you can avoid the traps that cost millions of Americans money every single year. Now let's talk about the two major categories of life insurance, because this is where most people get confused and where many get taken advantage of. Term life insurance is exactly what it sounds like. Coverage for a specific term, typically 10, 20, or 30 years. If you die during that term, your beneficiaries receive the death benefit. If you outlive the policy, it expires and there's no payout. No cash value, nothing. Whole life insurance, also called permanent insurance, covers you for your entire life, no matter when you die. But it also builds something called cash value over time. You pay higher premiums, a portion of which goes into a savings component that grows at a guaranteed rate. Here's what the insurance industry doesn't advertise loudly. For the vast majority of middle-class Americans, term life insurance is almost always the better financial choice. Why? Because the premiums are dramatically lower. A healthy 35-year-old can get $1 million of 20-year term coverage for roughly $50 to $60 per month. The equivalent whole life policy might cost $500 or more per month. The standard financial advice is this: buy term and invest the difference. Take that $450 monthly savings, put it in a low-cost index fund, and at the end of 20 years, you'll likely have far more money than any whole life policy would have accumulated. The math, in most scenarios, simply works out better. Whole life insurance does have legitimate uses: estate planning for very high net worth individuals, certain business applications, and for people who can never be without coverage due to health conditions. But if an insurance agent is aggressively pushing you toward whole life before understanding your complete financial picture, that's a red flag worth heeding. So how much life insurance do you actually need? Financial planners often use something called the DIME method. That stands for debt, income, mortgage, and education. You add up all your debts, multiply your annual income by the number of years your family would need support, include your mortgage balance, and estimate college costs for any children. That total gives you a baseline coverage amount. A simpler rule of thumb: 10 to 12 times your annual income. If you earn $70,000 a year, you're looking at coverage somewhere between $700,000 and $840,000. But here's what those formulas often miss: your spouse's income potential, Social Security survivor benefits, which can be substantial, your existing savings and investments. If your spouse earns a strong income and you have significant assets, you may need considerably less coverage than the formulas suggest. If you have young children and a stay-at-home spouse, you may need significantly more. The point is, don't just buy what the agent recommends. Run the numbers yourself. Or better yet, work with a fee-only financial planner who has no financial incentive to push you toward any particular product. When you apply for life insurance, you're not just buying a product. You're submitting yourself to a detailed risk assessment. Insurance companies employ actuaries and underwriters whose entire job is to calculate, as precisely as possible, the statistical likelihood of you dying during the policy period. They look at your age, your health history, your family health history, your body mass index, your blood pressure, whether you smoke, your driving record, your occupation, and sometimes even your credit and financial history. This evaluation process is called underwriting. Based on the results, you'll be placed into a risk category, typically ranging from preferred plus at the top, down through standard, down further to substandard for higher risk applicants. Your risk category directly determines your premium rate. A preferred plus 35-year-old might pay $40 a month for a given policy. A standard applicant of the same age might pay $80. A smoker, regardless of other health factors, will almost certainly pay 2 to 3 times more than a non-smoker for identical coverage. Here's the actionable insight. You can improve your classification before you apply. Quit smoking at least 12 months before applying for coverage. Bring high blood pressure under control through medication and lifestyle changes. Lose excess weight if you can safely do so. These steps don't just improve your health, they can save you hundreds or even thousands of dollars in premiums over the life of your policy. Sometimes the difference between risk categories amounts to more than $10,000 over a 20-year term. Now let me walk you through 5 mistakes that cost American families significant money every single year. Mistake 1. Waiting too long to buy. Life insurance gets more expensive as you age, and dramatically more expensive if your health declines. Every year you delay buying coverage is a year you pay higher rates later. The 30-year-old who buys coverage today locks in rates that the 40-year-old version of themselves would envy. Mistake 2. Not reviewing your policy after major life events. Marriage, children, divorce, buying a house, paying off a mortgage, starting a business. Each of these events should trigger a policy review. Your beneficiary designations and your coverage amounts need to reflect your current life, not the life you had 10 years ago. Mistake 3. Relying entirely on employer-provided coverage. Group life insurance through your employer is a wonderful benefit, but it typically covers only 1 to 2 times your annual salary, which is almost never enough. And critically, if you leave that job, you typically lose that coverage, often right when you need it most. Mistake 4. Assuming life insurance is unnecessary because you have no dependents. This logic fails if you carry debt that could become a burden for a parent or sibling. It also ignores the reality that coverage is dramatically cheaper when you're young and healthy. And mistake 5. Misrepresenting your health on the application. This one can be catastrophic. Providing false information on a life insurance application isn't just fraud. It can give the insurance company grounds to deny your family's claim at the exact moment when they need that money most. Always be truthful with underwriters. The consequences of dishonesty are severe. Life insurance is one of those topics most of us avoid thinking about because it forces us to confront uncomfortable questions about mortality and financial vulnerability. But the families who sit down, do the math, and make informed decisions about their coverage are the ones who are truly protected. If you found this valuable, please subscribe to Insure Smart.